Okay, fam, welcome back. So today we're going to be talking about the all-important Fed rate cut coming. So with that being said, let's get it. All right, so we're going to get deep into this. This is not going to be a super long video, but I will basically go over like the grandiose picture here of what really needs to be understood about what's coming. So the first thing I want to say is that the futures markets have adjusted according to their expiration dates. I know this because I was trading futures this morning and the equity indices needed to be rolled forward to the month of December. Well, December, as you guys can see, is priced in to be, or at least so it seems with this gap up, to be higher than where we currently are now. So that tells me likely that that there's a good chance that the markets may go up into the rate cut and even the day of the rate cut. Otherwise, I would guess between the timing of the Fed cut and the rolling of the futures market expiries for the equity indices that my guess is that they're working in tandem together, that it's not by chance that the futures markets have gapped up just shy of the Fed meeting. So let's go ahead and talk about first thing I want to talk about is the four major indicators that would be indicative of a recession. Okay. So we have unemployment, we have the SOM rule, we have the uninversion of the yield curve, and we have the labor market. Okay. Or sorry, unemployment. Which one was it? Unemployment, uninversion of the yield curve, the SOM rule, and then GDP. That's the other one. Okay, so let's talk about GDP first before I forget. All right, so if I was fully convinced, me personally, that there was going to be a recession on the horizon, I would not be seeing mixed indicators. Here's what I mean by this. I would, if I was going to be fully convinced that there was a recession on the horizon, I would not be seeing positive GDP and negative unemployment while seeing the SOM rule indicator get triggered, and the yield curve has not yet uninverted. Okay. So here's what I mean by this. Okay, GDP, you guys can see it's positive. It does show negative back here. There was one quarter during 2022 that was negative. Again, that kind of lines up with the recession we had back then. There was actually two negative quarters of GDP in 2022 during kind of that bear market, which in my opinion, 2022 was the actual recession. I don't think we're going to see an actual recession going forward. I think 2022 was it, and I'm going to show you another reason why. But basically, the government came out and said, no, two negative quarters of GDP doesn't indicate a recession. We're just going to change that. So they did. It doesn't mean that anything changed. It's just that during that time frame, in my opinion, that was the recession that played out. Okay, unemployment did not go to the moon. We did see a technical recession. The GDP did fall. It was brutal. I'm not going to lie. It was absolutely brutal as somebody that experienced it firsthand. So the other thing, so that's the first indicator. Okay, this one's positive. That's what's important to note here. So now if I'm going over to, see if I can find the money flow. Where's that one at? Here we go. So, and I'm well aware that this shows the chart of Bitcoin. Okay, the idea here is that M2 goes up, or Bitcoin goes up as M2 is going up mostly. The thing I want to point out here is that the M2 supply, global supply, did actually go down during 2022 as the Fed was hiking rates. You can see down here that it turned red. Okay. That's usually, when it turns red, that's usually not a good thing for crypto. So you can see it kind of happened back here during 2017. And again, I know this isn't about crypto, but usually the M2 money supply leads to a drop in the price of crypto. During this time frame, it did not actually lead to a drop in the stock market, although I think there was, if I'm not mistaken, I do believe there was one during 2018 when the Fed was going to hike rates. The markets freaked out, and then they dropped like 20% right around Christmas or something. But the thing I want to note here about the Fed rate hikes is they hiked rates at the fastest rate that they've done, as far as I know, in recorded history, or at least in the last like half a century. Okay. So that's probably part of the reason why the market sold off, because they interpreted what the Fed was doing as a danger zone scenario. Okay, like yikes. Like, okay, the Fed has zero control over what's going on. We're all going to get screwed. They got to do emergency hikes because if they don't, we might go to hyperinflation. There was a lot of fear in the air. Okay. So as a result, the M2 money supply went negative because the Fed raised rates. You can see that Bitcoin went down, but the traditional stock markets also went down during this time. Okay, so the Fed said that they were going to raise rates in November. That was actually the top for Bitcoin at that time, and then they actually raised rates in March. That was that 48,000 swing high on Bitcoin, and then boom, fell off a cliff into a bear market. But stocks also fell off a cliff into a bear market from that March 2022. That's when we saw the largest drop in stocks. You can see that follows the M2 money supply. So the point I want to make here about the money supply, okay, is that it's positive at this point. As a matter of fact, you can see it kind of went sideways and then we went up, right? So we now have a higher high on the M2 money supply. What usually leads to that? Well, you see a high here and then a higher high. And then what happens after that? An absolute explosion of money. Same thing back here. Same thing back here. I don't think I need to reiterate the importance of this. Usually higher highs and higher lows lead to the upside, right? We're thinking like this. We're thinking like this in terms of technical traders. Higher highs, higher lows equals uptrend. Okay, that's good for the expansion of monetary supply, which means, in my mind, the Fed's not just going to be cutting rates; they're going to be printing money too. Does that mean that this leads to a market sell-off? No, and I'm going to tell you why in a minute. Okay, so we talked about GDP. That's the number one indicator. Okay, the SOM rule, yeah, okay, sure, the SOM rule has been triggered. So once it gets above 0.5, usually that's kind of a warning sign. We saw that recently. Now, I'm not entirely sure if there is actually a time where this thing got above 0.5 where it did not trigger a recession. But I know that there has been times that the yield curve has uninverted and there has not been a recession. Okay, I am aware of that. So this thing's basically just going to show every time we got above a 50, we never actually got, or basically every time we got above a 50, we got into a recession. So I would say the SOM rule indicator is a little bit more bearish. But again, the GDP is bullish. Okay, GDP is still positive. A lot of people could say this is lagging. I don't think so. Okay, there's a lot of people from all around the world that are in the United States now. It's kind of is what it is. When Trump gets reelected, he'll deport these people accordingly to however he sees fit. And I suspect politics will want to, regardless of who's in power in the party, will want to adjust accordingly for a soft landing because, again, they don't want a recession. It makes them look bad, right? So that is helping to prop up the GDP in this country, and I don't think that's going to change anytime soon, at least not until probably closer to the end of 2025, maybe the end of 2026. There will be adjustments in time. There will be people that will be leaving this country. I would say probably in quarter percentiles every year. Again, don't ask me why that is because I cannot answer that question for you. I will say that's likely. So we have other countries also cutting rates. So don't think that it's out of the ordinary. Pretty much the whole consensus across the globe, more or less, is that there is going to be rate cuts. So the Fed eventually has to fall in line. We all know that. We'll talk about the stock market returns in a minute. So we touched on these two indicators here. So the Nikki Leaks thing happened, okay, and came out and basically said they told the markets without really telling the markets that, hey, you know what? Maybe the Fed might be thinking about doing a 50 basis point cut. I mean, look, I'm of the mindset that if they can afford to do it, if we're not too late in the tightening cycle to where they can afford to get ahead of the curve of being too tight and start cutting, basically front running the cuts ahead of, the the global tightening or the monetary tightening situation getting worse, if they can get front run and get ahead of that, I think they can. I absolutely think 100% that they can do so without causing a resurgence of inflation. I know a lot of people have been talking about inflation. Oh, if the Fed cuts rates, inflation is going to go to the moon. Guys, that's not necessarily true. Okay, you guys got to understand. The Fed cutting rates, inflation coming down is a lagging indicator of the Fed cutting rates. So even if they start cutting rates, even if they cut them aggressively, CPI could still come down, okay? But the goal here for the Fed, the mandate for the Fed, is that they cut rates to a point where we get that Goldilocks zone, okay? And I'm going to talk about that in a minute. So let's go over the other two indicators now. All right, so I'm actually going to move this over to a single chart. So give me just 1 second, y'all. I'm going to pull up the unemployment rate here. Again, it doesn't really show on the daily. Well, okay, never mind. I guess it does. But the thing I want to point out here is, yes, okay, the unemployment rate ticked up. Yeah, we have the golden cross. And I told you guys I was looking for this as a warning sign. But the reality is, if it was going to go up, it would have went straight up. Okay. And we didn't see that. We saw it go from basically, I think 3.7, 3.9 all the way up to 4.3, and then we had a downtick. Okay. I suspect something like this is going to continue to happen going forward. I don't think it's going to change. Okay. I think the unemployment rate is going to stay low or relatively low, probably somewhere between 4 to 4.5% until the Fed gets a little deeper into the rate cuts. I do think we're going to get a soft landing. But I mean, when we go back in time here, you can see historically speaking, usually the unemployment rate spikes from, I mean, it does tend to spike from about the level that we're at now, but that's not always the case. I mean, sometimes it's actually higher. You can see here it was at almost 4.6% when it spiked. Back here, it was at 5% when it spiked. Back here, it was at, in 1991, it was at 6% when it spiked. Back here, it was at 6.6. So if I just put the crosshairs right here, you can see that of all the times that this thing has spiked and actually started skyrocketing to the moon, more often than not, the unemployment rate was already higher to begin with than where it currently is. So in my opinion, I think that the unemployment rate is going to stay low, and I think it's still low compared to historical standards, which in my mind is a bullish indicator. I don't think this is bearish, okay? So now I'm going to go ahead and do the US let's see if I can find it, US 02Y slash US 10Y. We'll take a look at the yield curve. Okay, so the thing I want to point out here about the yield curve is, and let me see if I can pull up the markets next to this. Sorry, give me just 1 second, y'all. I gotta adjust this because I did not have these charts ready for today. I was busy doing some other stuff, so let's take a look at the times that the yield curve uninverts and what usually happens. So you can see that the yield curve uninverted back here. Okay, it uninverted back here. It was at this 100 point, but what happened? And again, this is on the monthly chart. Okay, so December 2018. This is when this thing went from, or not December 2018. So July 2019. It was above 1%. Okay, so it was inverted, and then it uninverted. And what happened for that? After that, markets still went up for many, many, many months. Now, in this particular situation, this was a pandemic, so this doesn't really count. Okay. Here's what's interesting about this. Okay. The yield curve inverted and the markets went down. That's not supposed to happen. Usually, when the yield curve uninverts, is when the markets are supposed to go down. But we didn't see that in 2022. Everybody wants to talk about the coming recession in 2024, but nobody wants to talk about the fact that there was a recession in 2022. Okay, there wasn't an employment recession. There wasn't a SOM rule indicator recession. There was a GDP recession where we had 2 negative quarters, and there was a technical bear market recession. What is a bear market defined as in the markets? A bear market is defined as a decline from the previous all-time high greater than 20%. What do we see here on the SPX? Minus 28%. But nobody wants to talk about that. Everybody just wants to say, oh yeah, it's going to be a recession in 2024, 2025. I don't think so, y'all. I really don't. Because it just looks bad. Look, the Democrats are in power right now. They want to make themselves look good so they can get reelected. Why would they want to cause a recession the same year they're trying to get reelected? It just doesn't make any sense. If I was a politician, which I'm not, and I was in power and I was on the side with the Democrats, which I'm not, I'm actually very moderate. I believe in being neutral in most cases. I would not want to cause the stock market crash. Why? Because a lot of the lobbyists and the people that are extremely wealthy, the banks that donate millions or billions of dollars to these politicians so they can get their little things put in their bills or whatever it is that they want the markets to go in the direction that they want, which in most cases is up because that's how you make most of the money. Again, it's risky being a bear. The loss potential is infinite if you're bearish. So if I go back here and we take a look at all the times that the uninversion of the yield curve did not invert, we did see a downturn. Okay, usually when it goes up, we see an upturn. When it goes down, we see a downturn. Okay, so history does support the uninversion of the yield curve leading to a downturn. Do I think it's going to happen this time? No, because again, the yield curve inverted and the markets went down. And as it was sitting at highs and getting ready to uninvert, what is the market still doing? It's still going up. So basically, here's what I'm saying. 2 of the 4 major indicators are bullish and 2 are bearish. But the 2 that are bearish are only slightly bearish. Okay. The unemployment rate is only slightly up from where it was at the lows. But even at the lows, it's low compared to historical standards. It's very, very low. Okay. I would be more worried if unemployment got to like 5% and the Fed was starting to cut rates. Then I would be concerned. But they're not cutting rates at 5%. Okay, they're cutting rates now while the unemployment rate's still relatively low, which in my mind says that's a bullish thing for the markets. Okay, so let's talk about the Fed rate cuts and the actual historical data here. Again, shout out to this guy Alex Justin for this information. This basically talks about the S&P 500 returns after the first Fed rate cut. You can see in some instances here it was pretty bad, but the vast majority of these instances after the first rate cut, going 3, 6, and even a year out or 12 months out, is actually quite bullish. Okay, so how many of these times did the Fed have to cut rates within the first 3 months? It was green versus red. Well, we have, what do we have here? 8 red and 1, 2, 3, 4, 5, 6 green. Okay, 6 months, we have 5 red and then 1, 2, 3, 4, 5, 6, 7, 8, 9 green. So the green outweighs the red here. And then 1 year, basically only 4 out of these, however many of these are green. Okay. So basically what I'm seeing here is that even though there were more red years than, or there was more red than green in terms of these quarters here, you guys are going to look at this. Okay. Most of these red quarters were not even that big. Okay. We had 1, 2, 3, 4 red quarters that were big. We had 1 5% down, 1 1% down, 1 4.5% down, and another, well, okay, that's basically the average. So never mind that. So 3 out of these, it looks like 3 out of the 7 were basically relatively low. So that gives us basically maybe a 40% probability of bullishness. But again, looking 6, 12 months out, usually the Fed rate cuts equals markets go up. Okay, that's what we're seeing here. So in terms of the outliers, which was the great financial crisis and the dot-com bust, again, the dot-com bubble was massive overvaluation of exactly what it sounds like, dot-com companies, tech companies. You can see this absolutely huge, insane return over here. Okay, we're up in the 700s compared to what does it look like between 2008 and 2023? Well, we're not anywhere close to that. Okay, the AI bubble that's coming up in the future, which I think is likely not to happen until somewhere around 2030, may eventually look like this. Okay, but we're not seeing it right now. So that tells me likely that valuations are still really not sky high, pipe dream expensive. So that explains why the dot-com bust happened. Then again, the 2008 financial crisis was because maybe not entirely, but because of the Lehman Brothers, and basically, the real estate market was overcrowded. A lot of institutions were handing out free money like candy, like, oh yeah, you have bad credit, you have no credit, you have like all this debt or bankruptcy or whatever. Yeah, sure. Here's a $500,000 loan for a house. And eventually things got bad. People lost their jobs. They couldn't pay the mortgage. And then, basically the stock market went minus 50% because of all the bad news. So the point I want to make here about the outliers in terms of like 2008 and 2000 is there was some extenuating circumstances regardless of how much the Fed cut by. Okay, it doesn't matter if it was 25, 50, 75, 100, they were going to cut however they were cut. But the point I want to make here is that there was extenuating circumstances that caused the markets to drop. Okay, what did we see in August of this year? The Japan carry trade. That caused the markets to drop. That was a black swan event. Nobody could see that coming. Same thing with the dot-com. Same thing with the GFC. What about 2022? Well, you had all kinds of nonsense going on here in 2022, like supply chain blockages, war, all kinds of other stuff, all kinds of nonsense just going on that caused the markets to drop off a cliff, not to mention the fact that the Fed was raising rates at historical rates faster than they've ever done before. Then you had the pandemic back here. So the point I want to make in terms of like people trying to predict a recession, usually when somebody tries to predict something, when they say, oh, this is going to happen or that's going to happen, guys, usually the opposite happens. Okay. It's what's known as an overcrowded trade. So basically, everybody's been talking about the Japan carry trade. Here's what's ironic about it. Before the Japan carry trade happened, nobody was talking about it. Nobody even knew what this thing was. Okay. I didn't even know what this thing was. And then all of a sudden, everybody started talking about it. It's one thing to talk about it, but then to try to play the act of God and say, oh, well, this is going to be a Japan carry trade 2.0. Guys, nobody knows that. Okay. I think people trying to predict the future that don't have the capability to do something like that, probably a bad idea. Just going to say. But, you know, if everybody's talking about it, the chances that it's going to happen is very slim. Okay. Probably non existent. Is there going to be a Japan carry trade 2.0? There could be, but I don't think so. Okay. Is there going to be a recession now that everybody's talking about it? Probably not. Again, you know, people have been trying to spit out fear and, oh, you know, everybody's going to lose their jobs, blah, blah, blah. We want a recession. You know, like all these people think that they think they understand what they're asking for. Oh, we want a minus 50% market correction. No, you do not. Okay. No, you do not. People think about what they want in the here and now, but they don't think about the future implications of what they're asking for. If these people ask for something like a 50% market drop and then 6 months later, like let's say they get what they want, okay, which they're not going to, but let's say in some alternate reality they did. And then 6 months later they lose their job because unemployment skyrockets to the moon. Well, now they have minus 50% in their portfolios and they have no job, okay? So I think it's a bad idea for people to wish for a recession. Just because you wish for it doesn't mean it's going to happen. Let me be clear about that. Okay. In terms of everybody talking about it, I think it's just an overcrowded trade at this point. People are talking about, oh yeah, recession, Japan carry trade. The C virus is going to come back to life and we're all going to get locked down. Guys, they've been talking about it since 2020. It hasn't happened. Okay. In 4 years, that has not happened. Again, that's another example of an overcrowded trade that everybody thinks is going to happen and never panned out. Okay. The lost decade. People were talking about the lost decade back here in 2021, 2022. Did we see a lost decade? No, we did not. What we saw is a massive cup and handle pattern, and then boom, the markets broke out to new all-time highs. This is how they try to get you guys. They try to get you by telling you stuff that and look, I'm not saying that a recession can't happen. Okay, it's always a possibility, but I think the Fed's going to get ahead of it, which is the morally right thing to do. But we just didn't see that play out. Okay, there was no lost decade, there was no big fat recession, there was no Japan carry trade 2.0, none of that stuff. You know, smart money, Wall Street, the banks, they're very good at what they do. Okay, they know how to manipulate people's minds and emotions. I think there's a good aspect to doing that, and I think there's a bad aspect to doing that. I'm not going to say which side of the trade in this case I think that's on, but just understand that it's my opinion that regardless of whether the Fed's going to cut by 25 or 50, and I do think at this point there's a higher likelihood that they could cut by 50. There's a bearish 50 cut and there's a dovish or a hawkish 50 cut and a dovish 50 cut. Okay. And in this particular instance, I think it's going to be dovish. Look, guys, I think that Powell is going to come in on Wednesday and he's going to talk up the markets. I think he's going to say, hey, we're going to do a 50 basis point cut. We want to get ahead of the cooling of inflation. We want to, maybe they may not necessarily say we want a soft landing, but maybe they give some kind of indication of that. Because again, they got to be careful with what they say. And I have every reason to believe that's true. Okay, the global liquidity is going up and global M2 supply is going up. Everybody's cutting rates. They're getting ahead of the cooling of, well, basically, I think that the nix of the crossover between inflation coming down and all the recession indicators going up, I think they're getting ready to cut at the nix of that at the perfect time, in my opinion. And I think they couldn't have picked a better time to do so. That's just my opinion. Okay. But I think they're going to get ahead of it. I think they're going to be dovish. Again, elections coming up in 2024. If Trump gets reelected, which he could just decide he wants another Fed chairman. Okay. Because I'll tell you right now, if there was some kind of market crash because the Fed was like, well, we're just screw them, we're just going to screw over everybody, which again they're not going to do because they need to make money too. Okay, these are human beings that they literally all they do is money. They do markets and money. That's what they do. They literally are I don't want to say the gods of making money, but if I could use a euphemism here, that's what I would use. Okay, they're the ultimate market makers. So they need to be able to make money. And the best way for them to make money is when the markets go up. They could sit on cash, sure, but who wants to do that? Time favors no man. Okay. Every man, every woman gets old. Why wait when we could just have the market rally now? You know what I'm saying? So I think the Fed's going to come out and be dovish about it. I think that if it was their intent to try to screw this up or if they were somehow going to fail, they probably would have already done so by now. Trump is likely to get reelected. Okay, that's the reality. And if he walks into office in a market that's unfavorable and it's pulling back or it doesn't look good to him, he's not going to like that very much. And he's going to be incentivized to want to replace Powell. And I'm pretty sure Powell doesn't want that because, the chair of the Federal Reserve is an extremely highly coveted job, extremely highly coveted. I mean, Powell, I don't know a lot about his history, but I think he spent like roughly about almost a decade working for the banks and the Fed and stuff like that before he even got elected as chairman. And by the way, just so y'all know, Powell actually was elected as chairman by Trump. So for those guys, Powell was already chairman before Biden got elected into office. So let's understand that, okay? So they already have a close working relationship. Powell knows that Trump's going to want the markets to look good so he can have something to brag about. Okay, we all know this, okay? So I think on Wednesday, I think it's good to be a little bit cautious, especially going into the elections. We're still in the bearish seasonality until we get out of September. It doesn't mean I think the markets are going to dump. I just think it means it's good to be, in my opinion, somewhat bullish, somewhat bearish. Okay. I personally, I'm bullish on the overall outlook because I have a pretty good feel for how these things are going to turn out, in my opinion. But I think it makes perfect sense, and even it's a little good to be a little skeptical and a little bit cautious. I don't think there's really a huge reason to worry. I think that the Fed will do what's right, and they will expand the economy. Companies will start to hire more slowly as the Fed cuts rates. Okay, the economy will expand slowly as the Fed cuts rates, and inflation will come down to 2%, and we'll get the soft landing. Okay, I think it's possible if the Fed is just willing to if they're willing to do something different than what they've done for the last 100 years, they can pull this off. But they may have to be data dependent. I hate using that word, but they may have to do it in order to pull this off. And in my mind, whatever it is that they think they need to do in terms of rate cuts and stimulating the economy, maybe they need to go just a little bit more bullish than that each time to kind of stay ahead of the curve of the soft landing turning sour, which I don't think is going to happen. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.